Good morning, good evening, good afternoon, wherever you are in the world. This is John with Tommy's Top Picks, here to bring you your weekly flesh and blood market update. I have some economic data to talk about as well, so we'll get into that after the charts. So stay tuned if you want to hear about general rambles on, inflation, unemployment, etc. We had some new data the last couple of weeks that's worth kind of reviewing just to give a macro perspective. These are things I'm looking at in my job, so useful if you want to kind of get a sense of risk on asset market things. Also, we will go over a card, just one. I don't have much else to say. I looked around to see if there's anything else I noticed that was kind of within my purview of watching, understanding, etc. Always recommend Stackswell if you want to do a regular card valuation, up, down, etc. He watches a lot more stuff than I do, and he does a great job. And we did get some charts, including heavy hitters. So let's jump in and discuss. All right, starting with unlimited boxes, Monarch is down 10% to 50 from 55. We've seen it in this range for the past month. We've basically been bouncing around this. It might be worth taking a look at this chart, the unlimited Monarch, just to see what's going on here. We speculated that there's some pullback from the post what's it called, Dusk Till Dawn kind of cool off and Angelaris cool off, because there's two little hype bubbles around the release of those. And I think we're just kind of settling back into where the supply meets the demand, as happens with dynamic markets. So down 10% is a pretty big deal, but down 10% back to where you were 2 weeks ago, not a big deal, right? So I think we're fine. Moving on, Tales of Aria down 5.36% to 56 from 59. This is a little lower than I would have wanted from these little pop-ups that we've had. So we had a push up, right, from these 40s to 48. Then we had this really weird one, which I think was just anomalous data, like a one shot, one box sort of thing. Then it hopped all the way back up to 60, and now we're kind of cooling back down. I was kind of hoping that this was a sign some of the supply might have been running out. I'm not so sure now. With this 2-week downward trend, you'd figure it'd keep knocking on the door every few weeks. Now, we'll give it another week or two, see if it continues to do so. But and let's look at the chart on this. But I have a feeling we're just settling back in, and I have no idea what the supply issue was there. Maybe distro, got a new wave in or something. I don't know exactly what that was. So worth looking at. We'll take a look at that chart. So Mon and Tails Unlimited. All right, moving all the way down to first edition boxes. WTR is down 7.45%. This is a very low price for WTR first edition boxes. I think we've seen it down this low maybe once or twice before. I believe way back there was a 2,200 price. But that was a long time ago. Recently, I don't think we've seen, maybe not that low. Maybe I'm mixing up ARC. It could be ARC. Let's see. I swear there was one that was lower before this. Real quick, 2750. No, this is the lowest price I have in record. Okay, so this is the very lowest single box. Again, TCG player. It's tricky to buy them off of here because you're going to get a crumpled box, you're going to get a damaged box, unless they have pictures posted, which this particular listing doesn't. It does show that there's a continual downward interest in these kind of old school boxes, sealed collectible situation. Obviously, you don't really want to open these kinds of boxes at this point because you're pretty much guaranteed not to get this value out of it. There's such a premium price on this sealed product here. And through TCG Player, it's not really the best. I'd go on eBay where you get pictures of the actual box, or somewhere, Discord, Facebook group, etc., where you get a picture of the box if this is what you're looking for, particularly if you want it for the shelf. Now, if you just don't care, you're going to crack it, which again, not recommended. Your value chances of EV is very, very slim on WTR in particular. More power to you, but it is the lowest price in the couple of years I've been doing this. So yeah, I mean, if you've just been waiting for the price to come down, it's down. It's as low as it's been. May continue to go down, may pop back up next week. We've seen it do both. But yeah, generally speaking, it is just kind of like the market softening on these old school collectible parts of Fab. Moving down to Evo, because everything else is pretty much just flat. Moving down to Evo, it's down 21% to 57 from 69. No big deal. We've seen this before. It is sad because it is one of the more recent sets, and it felt like they were kind of getting these under control, as you can see from these prices of the previous 2.0 sets. It looks like Evo just the supply and demand match is off. But remember, this was a very experimental set. Single class, focused purely on the drafting, or not the drafting, the limited play. It's not that surprising that this is struggling. It is a little surprising that the supply is too high, because it felt like they were getting a real handle on the ability to keep supply slim for those things that they thought would be less in demand. Maybe they just got it wrong. Maybe the Marvels are playing into this, because they're not super impressive, and it looks like they were a mistake, according to James White. So they're supposed to look like a regular Marvel, and there's a print mistake that they didn't realize till the last minute. So that said, it is probably going to be kind of a bad box for a while, just because I just don't see the same demand as you get for other, draftable sets. So anyways, that's just what that is. Hopefully they keep the supply limited and we don't get extra waves of this, so it can kind of kick it back up towards map. But that's where we are on that. Heavy hitters, just to note, is down 2.4%. As this is usually, I wouldn't call this out at all. I just wanted to kind of point out, yes, I did put it in here. Yes, I do have the charts. I've been tracking the price this whole time. It was down at the bottom and it wasn't part of the charts. Now it's part of the charts. This is very normal price action. We can take a look at the chart, but it's just the down and to the right that you see every time. As soon as it starts to kick up and we get that kind of Nike curve, then I will take a look at it again. I imagine that will happen in this price range, this 75 to 80, which we're almost there. I don't know for sure, but I do have a lot of confidence, and there is solid demand for heavy hitters compared to previous sets. So I really do think that they're getting the formula right as far as supply and demand kind of matching up. And while this is a post-release kind of getting bored situation, I don't know if people are actually getting bored of heavy hitters. It does not sound like it, but point being, shops have it. They're trying to empty some shelves to make room for Star Wars or, other new sets coming out, etc. What it boils down to is the post-release Doldrums is standard, normal, and nothing wrong with it. I actually do expect it to hold somewhere in this range, because it feels like they've gotten better and better with each one of these sets at tightening it. And I've looked at the data a few times. It's kind of hard to show it here, but to visualize it. But you can see this pattern of these releases, like 87, 85, like how fast it hits its low and then kind of recovers, is really interesting for each one of these 2.0 sets, and it's gotten better each time. It's a shorter time frame to do kind of that Nike check and sort of hang in that low area. So point being that I think this will be even better than the previous ones, as each set has been. This 2.0 thing does seem to be working. The warehousing that they're doing, the holding back of waves and then destroying extra product if they need to. I don't think they're destroying any of this stuff yet because it's too recent. But point being that they are managing and limiting supply, getting better data each set, and tightening it a little bit better to try to keep it at map, which is what their kind of promise to the LGS is, right? Because at map, the LGS can actually make a few bucks a box. Isn't that a great idea? Yes, it is. I mean, I think that's the whole point of selling a game and being good partners with LGS, which LSS definitely makes that as core to their mission. All right, moving on to Everfest. First edition cases down 7.14%. This is 2 weeks in a row we've seen it come down. As you recall, Everfest had this weird set of spikes up. To be fair, 224 is really just retracing back to where we were, was this in January, right? If you recall, we were even lower than that. This was the beginning of an upward trend, and then it spiked like crazy, and then it's now just cooling off essentially over a very long period. This is much more interesting to me than the spiky up and down. Now, typically the spiky up and down is a prelude to a jump to a new tier, a new basically stable area. This is a slow increase and a slow decrease. This feels more like, I'm not sure, honestly. Could this be related to the news? Maybe it's the news filtering out that Everfest there's no unlimited. It's probably the fourth least printed product out there if you can include unlimited in each set. And so maybe that's what it's about. And it just was the market filtering that information in, getting a little hyped over a slow period of time, and then slowly taking it out. There's also the idea that the box value, the M's, were super useful around previous sets, probably like Dusk Till Dawn and such. And now that's cooled off, right? That demand for those M's has cooled off a little bit, bringing down the demand for these cases. It's really hard to interpret that data from a case level data point, but it's interesting that we've seen this kind of, upward trend and downward. Maybe we'll look at that chart too. I'll see if I can remember that one. Honorable mention to Evo, down 4.5% on the cases to 330 from 345. Just calling it out because that's what we do here. And I just realized that doesn't match. Now it does. Okay. Sorry, heavy hitters didn't have the little line on it, and that made me sad. So, economic data. Inflation is up. I'm sorry, I'm mixing up numbers here. Inflation is up. I think it was 3.3% for CPI. I could be wrong on that, but it was up a little bit. Not a huge amount, and I think it is up 3.3%. I don't remember what the exact number is. Point being, it's a small increase, so inflation is not declining as the Fed had hoped. It is slightly ticking up, only a little bit, and these things get adjusted when they do the full math because they have to do the short-term math. I apologize for that beding. That is because I didn't mute last time Tommy was on and we were recording together. So what that means is the Fed is probably not going to pivot on rates for a while. They came out and said as much that they are not actually looking for any particular piece of data from here out, that basically they're comfortable with where things are and what they're doing. They don't look like they want to increase it, but they also said they're not interested in decreasing it anytime soon based on what they're seeing, and they're not looking for a particular thing. They're not like, okay, inflation drops to 2%, now we absolutely have to cut. They're basically saying, we're comfortable here. We're going to hang out here, and if this continues the way it's going, we're happy with that. I see that because as the Fed, again, you're trying to pull liquidity out of all markets. That's the goal. It's how you reduce inflation with the tools you have. And they are seeing some liquidity come out. Still, inflation is holding on. Now, I will say, of the inflation data, if you break down the different parts of it, what you end up getting is housing is the last bit. Housing is the one place inflation is holding up. It's not food. It's not gas. I know you'll hear that in the news because people are easily fooled by headlines, I guess. But if you actually look at the data, it's all housing. Well, it's mostly housing. I think something like 80% of inflation was housing, and there's like a bunch of different categories in the inflation calculation, and only one is actually driving the inflation number. It's housing prices. And the reality is that's a supply-demand thing we've talked about in the past. And if you look at the way, zoning codes work, there's a lot of other factors that go into that, and including like investment bankers buying up properties, which I think should probably be banned, just because housing is too critical a component. Obviously, it's tied to inflation, and it's messing with our ability to manage the economy. But that aside, that's kind of a personal opinion thing, not a factual thing. That aside, if you look at it, housing has started to cool off, not in the housing prices itself, but in the preliminary data of leases on rentals is starting to show rental rates are starting to show decline. They're cooling off in various regions. I mean, obviously, they're probably still record high. Cooling off just means not going up as fast, right? So point being, with that as a kind of a leading data point, that would then indicate that eventually you get to a point where houses can't be afforded by landlords that are kind of living paycheck to paycheck of their tenants, which is definitely a thing. At some point, they capitulate and sell their house. They take what money they can, including below market, and that's when you start to see that inflation decline from house prices. Now, downside to that, what happens if a giant investment bank comes in and buys it at market just to get it, and they do it with cash, or maybe they do it with cash and the transaction gets recorded, kind of like unstated amount. It happens, and that is a potential problem for bringing this part of the inflation rate down. What does that mean? Unfortunately, what it really means is the Fed should stop looking at inflation as a whole, either subtract housing out of it, which would be a terrible idea because you really need to include core needs of people to understand what's going on and how much pain there is in the market, or you get comfortable with a different rate of inflation, which I don't think they're going to formally address this policy, but it is kind of what they're signaling. They're saying we're not looking for anything in particular, i.e., what we see is okay, right? So they're kind of comfortable at this 3 and some change rate as opposed to getting it all the way down to 2. I think it might be higher if you count total, not just CPI, but total inflation, whatever it is, 4 maybe. Point being, they're comfortable with this higher or elevated inflation rate at this point, as long as there's some more factors showing slowdown. And that leads to the next thing. Unemployment rate hit 3.9%. Historically, we've seen a tipping point on the S&P and other indices around 4. Historically, we've also seen it dance at 3.9 and then decline. So it's just because that 3.9 does not mean expect 4, right? But when it hits 4, typically, and again, we're in a weird economic situation where typically doesn't really apply anymore, but it's still worth knowing history just so you can keep an eye on it. 3.9%, 4%. When that tipping point happens, you get a decline in the indices, in equities, and kind of a restructuring downward, recession or pre-recession kind of retrace situation. Do I think we're going to get a recession? So the only thing I can think of is if there is black swan event, some sort of emergency situation that causes a very unexpected turbulence in the market at this point. Now, that doesn't mean that can't change going forward, but right now the Fed is projecting to keep interest rates elevated, out into June. There's really no triggers right now on the horizon, short of like war or some sort of specific event. I will say the U.S. is looking stronger than the rest of the world as far as inflation control. It's managed to get it down lower than most of the places without tipping into recession yet. A number of large first world economies are in recession now. I think it was the UK, Japan, and I can't remember. There's at least one other European major economy that also hit recession as well. So what we're seeing is, the market globally is cooling. It is happening, pretty broadly, and the U.S. is dodging it so far. Do we get to a soft landing? Big question mark. It depends on who you listen to, and the reality is the data is so uncertain that we don't know. But we are seeing a cooling. Obviously, unemployment is a factor that does lead to some inflationary component, much less than you'll hear in the news. Honestly, a lot of inflation is, we've talked about this before, tied to record profits versus labor costs. But labor costs is one of the things the Fed tries to manage. So, and it's not the labor costs, they try to manage unemployment, which ties to labor cost. So we're at this weird, kind of neutral spot here where we may see, everyone getting used to it. And when that happens, that basically we could call it a soft landing. I don't think the Fed's ever going to declare a soft landing. I think they're just going to keep on floating along until what we see happen eventually changes. Now, I will say, I was just reading an article about it. They are doing quantitative tightening, i.e. unloading assets on their books at a fast rate, like really fast. And they're getting, I wouldn't say close to, but they are, and if you think about it, that is the goal of this sort of period of high interest rates, is to drain liquidity from the market. Well, guess what? They happen to be one of the largest liquidities in the market because they buy up all these assets in the quantitative easing period, right? So their balance sheet is part of what needs to drain and is what's draining. So as that kind of reaches the equilibrium, I know their emergency bank thing got closed down. I can't remember what it's called, but it was a specific program for liquidity for banks because they were worried about it. They opened it up, allowed for really cheap loans by banks, which again adds liquidity to the market. They closed that down recently. It basically shows that there isn't a demand for it, that now we see this draining of excess capital need. So we're starting to see all this balance sheet stuff tick into reality. And as that happens, I think that's where we start to see the rest of the economy have impact. Now, on the labor market component, because this is a big part of this, it's still above pre-pandemic levels. There was a hiring kind kind of craze that happened. And if you look back, someone put some data out about, I think it was Facebook, and I'm not going to quote the numbers, but I'm going to give you an example. Say they needed 20,000 people in 2019 and 21,000 in 2020 and 22,000. Like that was the linear growth of the company based on their growth. They actually went from 20,000 to like 28,000. Like they overhired by a lot. And then this draining, if you follow that linear line, it's just now reaching where it would linearly be in 2024. So call it 24,000 people, right? And again, making up the numbers. So they're now at equilibrium with the expected growth had the pandemic shock and overhiring not happened. So we're starting to see, and this is not just Facebook, it's happening across the board, we're back to pre-pandemic kind of levels of employment, which means we're close to either tipping into now it's downturn on employment or tipping into back to growth. It depends on what happens next, and that's kind of the interesting part that we're keeping an eye on. That said, no one knows, and I know for a while there was calling for some sort of recession to happen. I was expecting a quick crash. It did not happen. The Fed, I guess, managed it well because the crash does cause pain. I personally, historically, have been through long crashes, slow crashes, and long crashes are, feel more painful, but it looks like this one was managed. Now, granted, long crashes historically, I'm thinking like, I guess '08 wasn't really that long. It felt long to the rest of the economy, but the actual crash and markets recovered pretty quickly. But when it's a long crash, it's down and it stays low for a while for people's employment, et cetera, unemployment's high, et cetera, for a long period of time. We're not getting that, right? That didn't happen. Versus the short crashes that we saw, kind of like 2020, where it's like unemployment's high and then it's back really within a few months, a year, et cetera. That's the sort of thing that is easy to recover from. I think they didn't want to do that. I thought they were going to do that. I thought that's what was desired, but the reality is they didn't want to do that. They wanted to drain from the system, which I guess makes sense with inflationary pressures in place, which wasn't in place for those other two situations. So that's what they did. The slower kind of, not crash, but slower decline has been the goal, or is what the impact has been. I can't say if that was the goal. And so as a result, it's just taken a lot longer to see any of these impacts on the economy. As a result, we're just now seeing it now. This is like a year and some change later from when I was first talking about this stuff. So just something to keep in mind. It's a very interesting time. They did pull it off as far as a slow crash. Even if we do tip into recession, it does seem like it's very light if it happens at all. Manufacturing is back up. Supply chain constraints have basically been removed across the board. Inventory management of particular retailers and stuff is now rebuilding for the first time since 2020. So what you're seeing, there's like basically an oversupply of inventory, right? Because it was hard to get stuff. And then they've been draining it since we kind of tipped past that point and trying to get it back. And now we're starting to see a rebuild of inventory in a, kind of like positive growth way, not an emergency supply way, right? So, which is crazy. It's like we're on this other side of it for good chunks of the economy, right? We're talking retail, we're talking manufacturing stuff, which is good because that means less inflation. There's some interesting data around things like car sales. They're actually found that they could operate more profitably. This is individual lots, could operate more profitably with less inventory because some of that's financed and et cetera, et cetera. And demand has cooled because of the supply constraints causing price spikes. So basically, we're getting a readjustment in certain parts of the economy where we won't see it go back to what it was before, but it's like a middle ground between the two. And this is where I talked about getting used to it, right? I think the economy, different parts, not all of it, are getting used to this current rate of interest rates of et cetera. And if that's the case, then what we will see is a tick up in risk on assets, trying to bring this all back to what this has to do with cards. If the world gets used to these rates, instead of a decline in risk on assets, you'll see a tick up, but at a slower rate, which is probably good because it was growing for 20 plus years, super aggressive speed, and it got too high too fast, and it started to go, not parabolic, but you know what I mean, like much faster than it should for a healthy, steady growth. Now a slower, steady growth would probably be a good result of this kind of economic restructuring that we're seeing, which may mean keeping interest rates higher than people expect for longer, and just kind of living in this new paradigm where less risky assets are the way to go, which would have implications for cards. Basically you take your risk paradigm from low risk, low return, high risk, high return, and you change it to like low medium risk, low medium return, high medium risk, high medium return, right? So you close the band down towards the middle, and that looks like what we're seeing. That means equities they're kind of that low medium risk depending on which equities you're in. Cryptos and cards and things of that nature, which were basically places for people to seek outsized return with excess capital, will slowly drain or be less attractive, because basically there's less liquidity in the market to dump into them. So anyways, real quick on the cards, I just wanted to call this one out for Tommy. Unfortunately, it looks like it's kind of cut off. Kasai has sold 2 times this month for $370. I hate that you can't see that. Why? There we go. There we go. The stupid filter. That's why I always that thing. 370. It does seem this is kind of the market price. It is now for sale for 360. So I do expect it to drain a little bit, but it doesn't seem like there's like much motion in these. So we're kind of seeing where this lands for now. Obviously, if she LLs, it will go down. If there's anything meta changing, dramatic wins, etc., that will change it too. But Tommy, I think you're going to see this price and a little bit lower as the core, maybe as low as 300, but it does seem like this is where Lady Kasai will stand as the Marvel. So keep that in mind. Maybe save your pennies to get it. I don't know how low it will go. I could see it getting down to like the 250 range, but just looking at the other ones and where this is, it's settled here for now. So it may be a longer haul to get it down to a lower price. That one's for you, Tommy. All right, we're gonna call out a couple. Let's go look at Mon and Ellie in Unlimited. Oops, there we go. Yeah, okay, so this is a little crazy. We had this peak up. This is where I was talking about. I thought it would be a new plateau. It is not. We're back down to where we were before. This could still be an indication of a supply shock thing, but I'm guessing this is more based on Angelaris growth and less interesting because Angelaris really wasn't as good as people thought. That's my guess on that. Let me know if you have thoughts in the comments. Tales of Aria. Yeah, this just looks like noise. It just looks like there's noise in the market. Let's just keep an eye on it. And maybe this is the next new level, but this doesn't inspire a thought of, hey, this is a supply constraint issue. All right, and then we had one in first. What was it? Evo, wasn't it? Oh no, I forgot which one I said. Guys, I'm so bad at that. I really should mark them or something. All right. Well, I guess that's it on the charts. If you have any questions, comments, or concerns, please leave them in the comments below. Appreciate you guys. Hit like and subscribe and all those things that I always forget to tell people. And I hope you're out there cracking packs, playing games, and enjoying this hobby that we love. Until next time, have a good one.